A retired couple in Ohio sold their house last year, did everything right, zero taxable gain on the sale, followed every rule they knew, and still got hit with a $10,000 Medicare bill they never saw coming. Today, I'm going to show you exactly why that happened, how it catches people completely off guard, and the one form most people never file that can make it go away entirely. I'm Rasmus, and on this channel, we don't just tell you what to do. We tell you what it actually costs when you don't. Today, I'm walking you through 5 things you need to sell before retirement, and the hidden traps buried inside each one that will quietly destroy your retirement if you ignore them. Stay with me, because number 1 has a trap inside it that blindsides even the people who thought they had everything figured out. The first thing to sell is your too big house. And before you think you already know this one, you don't. Not the part I'm about to tell you. The case for downsizing is obvious. Kids are out, you're not filling the rooms, and you're paying every single month to maintain space that does nothing for you. Property taxes, insurance, utilities, upkeep. For most people between 55 and 70, this is the biggest monthly cost that's actually within your control. So selling makes sense. But here's where it gets dangerous. Medicare does not look at what you're earning right now. It looks at what you earned 2 years ago. That's the look-back window. So if you sell your home in 2026 and that sale creates a big income spike, Medicare sees it in 2028 and adjusts your premiums based on it. You're paying a penalty 2 years later for a transaction you've already forgotten. The system behind this is called IRMAA, the Income-Related Monthly Adjustment Amount. In 2026, standard Medicare Part B runs $200 to $2.90 a month. But the moment your income crosses $109,000 to $9,000 as a single filer, or $218,000 filing jointly, that premium starts climbing fast. And here's the part that shocks people. At the higher brackets, a married couple both on Medicare can end up paying over $10,000 extra in a single year. Not because of anything they did wrong, just because of the timing of one home sale. Now, most of you know about the Section 121 exclusion. Live in the home as your primary residence for at least 2 of the last 5 years. You can exclude up to $250,000 in gains if you're single, $500,000 if you're married. That's a powerful tool, but here's exactly where people go wrong. They apply the exclusion, see zero taxable gain on the home, and assume they're done. They are not. The Section 121 exclusion and the IRMA calculation are 2 completely separate systems. Even with no taxable gain on your home, your total income that year, Social Security, pension, investments, plus proceeds from the sale, can still push you over the IRMAA line and trigger those elevated premiums for the next 2 years. That couple in Ohio I mentioned at the start, that is exactly what happened to them. They applied the exclusion perfectly. Zero taxable gain. But their combined income that year between the sale proceeds, Social Security, and a pension pushed them straight over the IRMAA threshold. Nobody warned them. A letter from Medicare just showed up 2 years later. That story is not unusual. I hear versions of it constantly, and it is entirely preventable if you know what to look for before you sign. Here's something most people never find out. If your income spiked because of a one-time event like a home sale, you have the right to appeal that IRMAA surcharge. The form is called the SSA 44, Life-Changing Event Appeal. It can reduce or completely eliminate the extra premium. Most people never file it because they simply didn't know it existed. Before you assume that higher Medicare bill is something you just have to absorb, contact your Social Security office. That one form could save you thousands of dollars. So before you list your home, 3 things need to happen. Calculate your total projected income for the year of the sale, not just the gain on the home. Know exactly where you stand relative to the 2-year Medicare look-back window, and sit down with a tax professional and a Medicare specialist before you close. Not after, before. Sell the house if it makes sense, just don't let the timing catch you off guard. Now let's talk about number 2. And this one surprises people when they see the actual numbers. The extra car. I know someone, retired after 30 years in her career. When the kids were young and the schedule was packed, 2 cars made complete sense. She retired, Kids moved out. Her husband retired a few months later. And for the next 2 years, that second car just lived in the driveway. Used once a week, maybe less. Insurance still running. Registration every year. Oil changes, whether it needed them or not, just sitting there costing money every single month. Here are the real numbers. According to AOA's latest annual driving cost report, the average cost to own and operate a vehicle in the U.S. now exceeds $12,000 a year. That is over $1,000 a month for a car that may barely be moving. Insurance, registration, maintenance, and depreciation do not pause because your driving habits changed after retirement. Before you make any decision, run what I call the 60 to 90-day test. Put the second key in a drawer for the next 2 to 3 months. Operate as though you've already sold it. Every time you genuinely need that second car, not just prefer it, actually need it, write it down. At the end of that window, look at the list. Most people come back with 3 or 4 real instances over the entire 90 days. That is not a sacrifice. That is $800 to $1,000 returning to your monthly budget every single month for the rest of retirement. Before I get to number 3, if this is giving you something to think about, hit subscribe right now. We put out content like this specifically for people in this window between 55 and 70, and you do not want to miss what's coming. Now, number 3 is the one people feel the most resistance around, the stuff in storage. The RV that was going to be the great retirement adventure, sitting in a storage unit at $300 a month. The boat with the engine issue that's been almost fixed for 2 years. The classic car project that stalled when real life got in the way. The motorcycle that came out a handful of times last summer. I've heard every version of this story. And here's what nobody wants to say out loud. A mid-size RV costs you between $5,000 and $10,000 a year in storage, insurance, registration, and maintenance, whether you use it or not. A 25-foot boat at a marina runs $3,000 to $5,000 a year just to sit there. These are not assets. They are subscriptions with a tarp on them. The test is simple. If you haven't used it in 90 days and there is no specific scheduled use in the next 60, it is not an asset. It is a recurring expense you are paying out of habit. I know these things carry memories. The first summer with the camper, the fishing trips, the project you plan to finish. But those memories live in you, not in the object. Selling it doesn't erase them. It just stops the bleeding. Number 4 is the one that will genuinely surprise you, because it's already inside your portfolio right now, quietly working against you. I want to tell you about someone I'll call David. Retired engineer, disciplined saver his entire career, did everything right for decades. One year he sat down to review his statements and realized the market had posted double-digit returns for 2 straight years, and his balance had barely moved. He called his advisor. It took 45 minutes on the phone before he finally understood what he'd actually been charged. Not because anything dishonest happened, but because the products were layered enough that the total cost had never been clearly laid out for him. That is the real cost of financial complexity in retirement. And David is not unusual. Here is the standard I want you to apply to everything you own right now. Can you explain this financial product to someone in your family in one sentence? If you cannot, that product deserves serious immediate attention. 4 things to specifically examine: variable annuities with layered fee structures, base fees, rider charges, sub-account costs. When you add all of it up, the total can reach 3 to 4% annually. On a $300,000 account, that is up to $12,000 leaving your balance every year. Not as a visible charge, just as returns that never show up. Whole life policies structured as investment vehicles rather than protection. Understand exactly what you have and what it's actually costing you. Actively managed mutual funds charging over 1% annually. Not automatically a problem, but you should know precisely what you're paying for. And any investment generating a K-1 tax form, that means the investment controls when income is recognized, not you. In retirement, that can create taxable income at exactly the wrong moment. Sit down with a qualified professional and ask 3 direct questions. What is my total annual cost across every account I own? What happens if I need cash quickly? And what does my family actually receive from these products when I'm gone? Is it simple for them, or is it a mess? You don't need to liquidate everything complex. You just need to understand what you own. In retirement, being unclear on this is not a minor issue. And now, number 5. This is the one that ends more retirements than the house, the car, the storage unit, and the financial products combined. And almost nobody wants to say it out loud. I want to tell you about a woman I'll call Margaret. Retired at 64, had saved carefully her whole life, had enough to be genuinely comfortable. Her son went through a difficult divorce in his late 30s. She helped him. Of course she did. She's his mother. Then the help continued. Rent 1 month, car payment the next. Then it was just a regular transfer every month with no real end in sight. By the time Margaret was 71, she had quietly drained over $180,000 from her retirement savings. Not in one decision, in 100 small ones. Each one felt like the right thing to do. None of them had a finish line. Margaret told me she wishes someone had given her the words to have that conversation earlier. That's exactly why I'm giving them to you today. Open-ended financial support for adult children. No defined amount, no end date, no stated conditions, is one of the most common and most damaging financial patterns in retirement. And it persists precisely because it doesn't feel like a problem. It feels like being a good parent. Bankrate research found that 68% of parents reported making significant financial sacrifices for their adult children. 43% said it directly impacted their retirement savings. Nearly half, and in the vast majority of those cases, there was never a real conversation. The support simply continued because no one wanted to be the one to establish the terms. The solution is not to stop supporting your family. It is to put a structure around it. Define the amount. Set a clear end date. Limit it to genuine needs rather than ongoing lifestyle support, and have the conversation directly. If you need the words, here is what I would say. I love you, and I want to support you. Here is what I'm able to do. Here is when it ends, and here is what I expect us to work toward together after that. I am your parent. I am not your bank. That conversation is uncomfortable. It is considerably less uncomfortable than calling your adult child at 72 and telling them your savings are gone. Here is the truth about everything on this list. Right now, on today, every single one of these is still within your control. Some require one phone call. Some require one honest conversation you've been putting off. But every year, these decisions sit untouched. They get more expensive, more complicated, and harder to reverse. You are in the window right now where action still gives you real options. That window does not stay open indefinitely. Pick 2 things from this list. Write them down right now. Identify one concrete action on each before the end of this week. Not a full plan, just a first step. Drop a comment below on type cell and tell me which one is the hardest for you to let go of. Those are the comments I look forward to most, and if someone in your life is in this same window, a spouse, a sibling, a close friend, send this to them today. Not later. Today. Because the people who watch something like this, close the tab and do nothing, they're not bad planners. They just kept thinking there was more time, and then there wasn't. Don't be that story. Remember that couple from Ohio I mentioned at the very start? They found out about the SSA 44. They filed the appeal. They got their money back. That is exactly what this channel exists for. So that you have the information before it costs you, not after. I'm Rasmus. This is Rule by Seniors, and your retirement deserves to be protected.